Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe. Today's topic is partnership.
At the end of the lesson, you should be able to understand why persons form a partnership business, identify the disadvantages of running a partnership business, distinguish between a limited and an unlimited partner, identify the features of a partnership agreement, and the final one would be to understand the rules if no partnership deed exists. So what would you do if there is no partnership deed? So we'll run into definition first, and that is a partnership is a form of business ownership when two or more individuals work together with the intention of making a profit. And the maximum there would be 20 individuals. So that would be 2 to 20 individuals working together with the aim of making a profit. Why persons form partnership? Why partnership? Now, the first one is that there is an opportunity to raise more capital. So more capital can be raised. Another, pooling of skills and expertise benefit the partnership. So the pooling of the different skills that the individuals, the different partners will take to the business, the different expertise, in the end, that will benefit the business. Another, sharing of managerial responsibilities. So the fact that you have more persons there, a part of the business, owning the business, then of course the responsibilities of running it would be shared. No one person would have all that workload to take on. In continuing, it is ideal for professional practice such as medicine, accounting, law. So those are some examples of businesses or practices that can be facilitated under a partnership. Another, profits from the business are taxed as personal income. So the profit from the business are taxed as personal income. So those are some typical advantages basically of a partnership. These are the reasons why persons would form a partnership. But why not partnership? What are the disadvantages then of a partnership business, or why would someone not operate a partnership? And of course, they're looking at the disadvantage. So the first one there is in almost every case, each partner will have unlimited liability and may be responsible for the debts of others. So that is a reason some individuals don't like being a part of a partnership. The other, it is dissolved if a partner dies. So once a partner dies, then of course the business will dissolve, the partnership will dissolve, meaning it will come to an end. Another, decision making can be more difficult or take longer to make. Another that is not on the list there, each partner is bound by agreements made by all the partners. So coming out of decision making can be more difficult or take longer to make. Once that decision is made, then of course, each partner will be bound by those agreements made by all the partners. Because of course you're in business together, so definitely you would be bound by that. Now we're looking at the characteristics of a partnership. What are the characteristics of running a partnership business? And the first one, a minimum of 2 partners and a maximum of 20 partners. That was stated earlier. Remember, the partnership, there is a minimum of 2 partners and maximum 20. Another is partners provide the financial capital needed. So a characteristics of the partnership is that because you have the individuals coming together to form this business, they will pool in together their capital. So therefore, it provides the financial capital that is needed. As opposed to if you're running a sole trader business, that would only be one person, and it may be difficult for you to generate that capital that is needed to start that business. Another is sharing the profits or losses. So you'll find that in the partnership business, because you are owner of this business, the profits or losses are shared. Another characteristic is that the partners bear the liability for all debts incurred by the business. The partners bear the liability for all debts incurred by the business, except in the case of a limited partner. We'll look at that later on. Another one is they must obey the law as given in the Partnership Act of the Commonwealth. So those are the characteristics of a partnership. Minimum 2 persons, maximum 20, provides the financial capital needed, sharing of profits or losses, bear the liability of all debts. So the partners bear the liability of all debts incurred by the business, except in the case of a limited partner. And they must obey the law as given in the Partnership Act of the Commonwealth. So I've mentioned the term limited and unlimited partner earlier. But let us look at limited partner versus the unlimited partner. So limited compared to the unlimited partner. A limited partner is a partner whose liability is limited to the capital invested in the firm. They can lose their capital, but they would not be asked to pay any extra money to clear off any debts of the business. So what they would lose is just their capital. Now for the unlimited partner, these are partners that are liable to pay the debts of the partnership irrespective of the amount of capital that they have invested. So the debts that are there in the business, they would be required to cover those debts. Now, if necessary, partners can be forced to sell their personal possessions to pay their share of the debts. So if it is that you're running the partnership, there are debts in the business, you are an unlimited partner, you are responsible for those debts, irrespective of if your capital contributed is lesser than that of the person that contributed more. Vice versa. If it is that you're unable to pay the debts of the business, then of course you can be forced to sell your personal possession. So if you have like a motor car and there are debts that should be covered in the business, then of course you may be forced to sell that car to cover that debt. All right. So that is basically limited and unlimited partner. So the limited partner, basically, they can lose the amount of capital that they have contributed, but in terms of any excess that should be paid to cover the debt, it would not exceed the amount of capital that they would have contributed. While for the unlimited, they are liable to clear off the debts of the business. However, if they are unable to, based on what they have in the business, then they may be forced to sell their personal assets in order to cover that debt. Okay? So we're on to the agreement of the partnership, which is basically the partnership agreement. It is also referred to as the partnership deed. And basically, these are the rules in running the partnership. And these are agreed upon by the partners of the business. Now, what are the items that are found in the partnership deed? Apart from the name and the location of the business, etc., we have the capital to be contributed by each partner. So that is shown in the partnership deed. How much capital Tom brings into the business, how much capital Ari brought into the business, how much capital Jay Lee puts into the business. So that would be in the partnership agreement. Another is the ratio in which profits or losses are to be shared, whether equally, etc. So that will be indicated in the partnership deed. Another aspect of it is a rate of interest, if any, to be charged on partners' drawings. So the partners may take cash or any assets from the business for personal use. But to limit the amount of drawings that the individuals take from the business, they would agree to apply a rate on that for interest. So they would charge them interest. So basically the interest is a penalty on the drawings that they have taken from the business. Salaries to be paid to partners, if any. So if the partners are to get salary, this would be included in the partnership deed. And of course, partners would get salary because basically they have taken on special role in the business and therefore contributed more to the managerial and to the management and running of the partnership. And that is why the agreement would be to pay the partner salary. Another is rate of interest, if any, to be paid on capital before profits are shared. So that is interest on capital, basically. And interest on capital is simply a reward for each partner in the form of a share of profits that is related to the amount of capital contributed to the business. So it is a reward that is given to the partners. So if it is that the partners, say, for example, contributed $100,000 to the business, the partners may decide in the agreement stage that each partner would get 10% interest on the amount of capital that they have contributed. So 10% of the 100,000 would give you 10,000. So that particular partner would get 10,000 as their interest on the capital that they would have contributed to the business. And the final one is arrangements for the admission, retirement, and death of a partner. So what arrangements would be put in place in the business should, in case a partner retires, there's a death of a partner, or if they decide to admit a partner. But in admitting the partner, of course, then all partners would have to be in agreement before you actually decide that you're going to admit a partner in the business. So these are aspects of the partnership deed. So we have looked at the agreement, but do you know that there are cases where there are businesses, there are partnership businesses that are being run without any partnership agreement? There is no deed. So what is done? How is it that they go through if there is no agreement? Right? Now, the first one there is that profits and losses are to be shared equally. So once there is no deed, there is no partnership deed, profits and losses are to be shared equally. The other, there should be no interest charged on partners' drawings. So once there is no partnership deed, there should be no penalty on the drawings taken from the business by the partners. The other is that no partner is to be paid salaries. So salaries, there should be no salaries to be paid to partners. In terms of interest on capital, there will not be any reward on the capital contributed by the partners. So there should be no interest to be paid on capital. So there should be no interest on capital. And the final one there is that where you have excess of capital contributed by a partner, the partner is entitled to an interest. So for example, J. Lee should have contributed $200,000 based on the agreement, right? But she went ahead and contributed 100,000 in excess of the 200,000. So that would be 300,000 overall. Now, the amount that J. Lee would receive interest on capital for would be the excess of the 100,000, not the entire 300,000, but only $100,000. Now, we have come to the end of our lesson for today. And when we started out, the aim was to understand why partners form a partnership. Remember, that is basically the advantages of forming a partnership. All right. And one of them is where the profits and losses are shared, right? More capital is generated into the business when you run a partnership. The disadvantages, so why wouldn't someone be a part of a partnership? So basically, those are the disadvantages of a partnership. Remember, one of them is where it may take a longer time to come to a decision, to make a decision. And in terms of unlimited liability, you'll find that the partners would be able to cover all the debts of the business where there is unlimited liability. The other is distinguish between limited and unlimited partner. For the limited partner, the debt is only limited to the amount of capital that they contributed, so they can lose their capital. While for the unlimited liability, remember that the individual would be responsible, the partners would be responsible to pay off the debts of the business. And if it is that they're unable to clear the debt, then of course they may be forced to sell their personal asset, their personal possession. The other is identify the main features of the partnership. And these features are the amount of capital to be contributed by the partners, by each partner, how profits and losses are to be shared, the rate of interest to be charged on drawings, the rate of interest to be paid on the capital that the partners contributed, which partner is to get salary, if any. So those are the features of the partnership deed. And the final one is to understand the rules if there is no partnership deed. So if there's no deed, remember, profits and losses must be shared equally, no interest on drawings, no interest on capital, no salary. So those are some guidelines in running the business if there is no partnership deed.
Like, share, and don't forget to subscribe.